Thanks for clicking! Canada's inflation data came in a bit hotter than expected in October, coming in at 2.2%, up from the 2.1% that had been expected by economists. With that said, measures of core inflation, those measures which the Bank of Canada at least at one point focused on when deciding interest rate policy, came in right where the central bank would want them to be. And this data comes amid two important reports out from the central bank last week. The first, a market participant survey, saying the central bank's next move will be a rate hike, and the other, the summary of deliberations, showing a central bank not in the mood to cut anymore. Yet, as we'll see today, this is a central bank that has left itself some outs, left itself some room for further rate cuts, which could very well be on the table.
I have it on very good authority that...
So what I want to do today is go over Canada's inflation data for the month of October, take a look at these two reports out from the central bank, and then go over some implications. This is the final inflation print that we're going to receive before the bank's final policy rate announcement on December 10th, with a press conference held thereafter, and we'll obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. Onto the inflation data. As mentioned, Canada's inflation in October came in at 2.2%, slightly higher than the 2.1% that had been expected. Major upward contributors to the month-over-month increases included property taxes, travel, telephone, rent, and cars, while gas, traveler accommodation, natural gas, fresh vegetables, and internet push prices down. So if you'd like to stay or leave, it's more expensive to do so, but on the other hand, it's easier to eat and watch YouTube.
That's like money in your pocket.
But while headline inflation was a bit higher than the bank would want to see, core measures of inflation, those measures which the bank at least at one point used to focus on when deciding interest rate policy, didn't show any sign of increases, with core median coming down 3.1 to 2.9 and core trim easing from 3.1 to 3.0. And further, that's just the year-over-year data. If we look back at CPI trim and CPI median's month-over-month data, we don't see any identifiable upward trends in price increases, with both month-over-month measurements remaining relatively flat. Now, as some of you may remember, back in October, the central bank said it's not going to focus so much on these measures of core inflation when setting interest rate policy as it once did, but it didn't really give us any other indicators either.
God forbid you explain.
That's right.
Further, as National Bank pointed out earlier on in November, the bank's relationship with the measures it uses to influence interest rate policy has been pliable to say the least, often picking and choosing the measures that it wants to justify its policy decisions. Yeah, one of the big six banks openly criticizing Canada's central bank for what it calls openly Groundhog Day behavior. You don't see that overly often.
And now you're going to get fresh about it.
So yeah, while the central bank says it's no longer focusing solely on these gauges of inflation when deciding interest rate policy, as history has shown, that relationship is pliable. And if the bank were to be looking at these gauges, it would be happy with what it saw. Yet this isn't what we're seeing coming out of the market participants survey, with the median responses expecting the central bank's next move to be an interest rate hike, coming in 2027. The bank surveyed 30 financial market participants, including banks, pension funds, BlackRock, etc.
No.
Those participants also expected inflation to remain relatively elevated over 25 and 26, coming in between 2 and 3% for both years. With that said, looking a little bit closer, these projections are based on a fairly optimistic view of Canada's economic development, with real GDP growth expected to come in between 1 and 3% over the next 2 years. But I'm not overly sure that they're not being overly optimistic on Canada's economic outlook, projecting a relatively not awful economy over the next few years.
There's your bumper sticker.
Now, yes, on the surface, the economy doesn't look overly bad. Unemployment just came in at 6.9%, falling for the first time in 3 months. However, a lot of those jobs that were added were driven by part-time work. Further, a lot of the jobs that were added were in the retail and warehouse sectors, stuff you need for the holiday season. Meanwhile, construction jobs all coming in very, very dismal. So I'm just not sure that the unemployment data is supporting this strengthened view of the economy heading into 26. Further, this data isn't going to show any of the projected layoffs that we're seeing coming from the auto sector on nearly a weekly basis. The auto sector is getting hammered almost every week, which is obviously a grim outlook, but one with which I think it's difficult to argue.
It's a great time to buy.
Drawn right from the headlines. And my guess is the central bank very much knows this, even if the headlines on its summary of deliberations seem to indicate that it's not going to be in a rate-cutting mood. The bank said in those deliberations, which my guess is are highly considered before they're released, that it's close to the limit of what it thinks it can do to support the economy during a trade war. However, and here's the key, the bank left itself a great big caveat, noting that its assessment was contingent on inflation and economic activity evolving broadly in line with the October projection, meaning the central bank could in fact change its mind on rate policy if GDP doesn't grow at 1.1%. So while yes, the central bank is portraying itself as no longer interested in rate cuts for the time being, it's left itself a great big out, saying that if the economy weakens, bringing inflation down with it, there is room for it to change its mind. And even the market participant survey that we discussed a few minutes ago puts the odds of a recession sitting at 35%. And here's the important part, that survey was conducted between September 19th and October 1st, before a lot of these great big downbeat market headlines, a lot of these auto sector layoffs were even announced. And look, as we've discussed before on this channel, even if the central bank thinks that the economy is going to be much worse than they're letting on, they are not going to tell us. They don't need headlines circulating throughout the country saying that the central bank is expecting a recession. If those headlines circulated, people wouldn't borrow, they wouldn't spend, which is what the central bank needs us to do.
It is never ending, your bullshit.
Again, what do they want versus what they say? They are trying to affect behavior, of which, according to a study released just last week from the central bank, they are very well aware. So we have headline inflation coming in a little bit higher than expected, but measures of core inflation remaining relatively subdued, not showing any dramatic month-over-month growth going the way that the Bank of Canada, at least at one point in time, wanted them to. Further, while market participants expect the next move from the central bank to be a rate hike coming in 2027, those projections are based A, on a relatively optimistic view of the economy, and B, came in before we saw that string of layoffs coming from the auto sector. And finally, the central bank has left itself ample room to change course if the economy continues to weaken. And I just can't see how it doesn't. We're seeing announcement after announcement of auto layoffs. We're seeing layoffs in other sectors, not to mention the renewal wave, which hasn't even crested as of yet. And further, that's also not even to mention the ongoing trade war that we're seeing coming out of down south and the uncertainty stemming therefrom, and also not even to mention ongoing increases in power of sales, late payments, and foreclosures. The economy, I think, is just much, much more weaker than it seems, and we're seeing ongoing headwinds that are not likely to recede anytime soon. As such, I think the central bank very much still has more room to cut, as I think the economy is going to necessitate it, and I think the central bank very much continues to plan on cutting as well. With that said, we will obviously continue to track central bank policy on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.